In an article I wrote recently, I spoke about the bubble being about to burst on the world's stock markets. If that's what happens, there'll be one group of commodities that people turn to not only to weather the financial storm, but to profit from it. In the third of this How to Invest series, we're looking at how to invest in precious metals. When people talk about investing in precious metals, the first one that springs to mind is gold. Gold's qualities make it one of the most coveted metals in the world. Not only is it nice to look at, but it can be shaped and sculpted into pretty much anything you can think of, hence the extensive use of gold in jewellery. It's also a highly effective conductor of both heat and electricity. And these characteristics have made it the metal of choice for those tiny relay contacts and connectors in mobile phones and computer circuit boards. Yes, that's right, you probably own a tiny amount of gold already. But before you get too excited, each mobile phone contains just 50 milligrams of the precious metal. That's 1/500th of a gram of gold, so don't go handing in your notice and reaching for the sombrero just yet. But it's not just its characteristics that make gold a highly prized commodity. Its rarity is the real key to its value. Even with today's modern technology, gold is incredibly difficult to find. In total, just 160,000 tons of gold are in circulation across the world. That might sound like a lot, but compare that figure to the coal reserves in America alone, which stand at 255 billion tons. And you start to get an understanding of just how rare gold is. And don't forget, gold is much denser than most other materials, which means it's very heavy, and formed into a single cube, the total amount of gold in the world wouldn't even cover a tennis court. And new gold is only being mined at a rate of 2,600 tons a year. That's about enough to fill a pokey one-bedroom apartment in London. These facts mean that gold is a popular commodity to hold, and for many savvy investors it will make up between 10 and 15% of their portfolio. When outside pressures such as political instability, war, or high inflation affect the stock markets, it's gold that investors turn to as a safe haven. That means when many stocks are on the downward slide, gold will come rising to the top. It acts as a kind of insurance policy for your portfolio. So what's the best way to invest in gold, you're probably asking? Well, there are three distinct methods. The first is to buy physical gold. And websites like bullionvault.com offer easy access to that market. The gold will be registered in your name, and they offer low-cost, secure storage in the UK and in places like Singapore and Zurich. Gold bullion can also be purchased in coins or bars and is typically 99.9% gold. Gold coins have an advantage over bars that they're more flexible. I mean, it's easier to sell 20% of your gold if you own 10 gold coins rather than all one big gold bar. For the same reason, you'll probably find that coins are that bit easier to sell. The second way to invest in gold is through exchange-traded funds, or ETFs. Here you never actually own the gold yourself, that's owned by the provider of the ETF, and you become a beneficiary of effectively the debt they owe you. It's a kind of a gold-plated IOU. Your investment allows the fund to buy more gold, and when you want your money back in the future, the amount you get back will depend on the value of gold at the time of your request. ETFs provide a cheap and convenient way to invest in gold. There's a lower entry point, and you don't have to worry about where you're going to store your gold or how much that storage is going to cost. The downside for me in this scenario is you can never really be sure that the ETF in question has actually bought the physical gold to back up its debt, and that invites an extra level of risk into the equation. If there's a sudden panic in the market, will they have enough gold to cover their commitments? If you don't want the hassles of owning physical gold and you're not keen on the gold-plated IOU from an exchange-traded fund, another way to invest is through the mining companies themselves. Barrick Gold, Newmont Mining and Goldcorp are some of the many gold miners that are available to invest in through the stock markets. Shares of precious metal miners are typically leveraged to price movements in the precious metal they mine, and they're a good way of getting many times the increase in the spot price of gold. But shares in gold miners have been highly volatile recently, and their price has been hammered in recent years. The upside may be that with mining stocks now sitting at long-term lows, as Yaz and her plastic population once said, the only way is up. Like all investments, the price of gold can and does go down as well as up. So it's hugely important that any investment you make is part of a well-diversified portfolio. But if you're relying on paper money issued by bankrupt governments as a store of value for your wealth, be very careful out there. A much better option is to have your own business, and an easy way to start that is through platforms like eBay, Amazon, or even Etsy.